Gold's been moving sideways, but the trading game has absolutely changed. What could cause price fluctuations in the short term, and what would it take to see a strong trend again? For all the details, check out this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. So over the past week, gold prices have actually continued to consolidate within the range since early February. Geopolitical tensions and some tariff updates have been affecting price movement, while uncertainty surrounding the Fed rate path and the shadow of stagflation have become key factors driving gold's next move. With the Fed now in its pre-FOMC blackout period, tonight's US CPI data could influence market expectations for future Fed rate cuts, causing extra volatility in gold prices. So now if we take a quick look at the gold against US dollar daily chart, we can see that after the V-shaped reversal at the beginning of the month, gold continued to trade between $28.80 and $29.40 last week. Both bulls and bears have been alternating, creating a standoff, and the reactions at the edges of the consolidation range are still worth paying attention to for traders. While, recent gold prices movement may seem somewhat dull, as we mentioned in last week's video, the pricing logic for gold has fundamentally shifted since March from an inventory play to a rate cut play. On one hand, concerns over the US economic outlook persist. February's non-farm payrolls came in at 151,000, below expectations, and the unemployment rate rose to 4.1%. The Atlanta Fed's GDP Now forecast indicate that the US GDP will contract by 2.4% in Q1 25, marking the first negative growth since the pandemic. Against this backdrop of economic slowdown, the US administration's swing tariff policies and ongoing fiscal tightening have fueled expectations for rate cuts. Market pricing currently suggests that the Fed will implement 325 basis point rate cuts by this year. And on the other hand, there's growing market skepticism about the potential for stagflation in the US. Given that inflation remains quite resilient and the 5 to 10-year inflation expectations from the University of Michigan's February survey rose to over 3.5%, Powell reiterated his stance of not rushing to cut rates after the non-farm payroll report. However, concerns over slowing employment data, the looming risk of a federal government shutdown on Friday, and the demand for U.S. Treasury as a safe haven asset amid volatility in riskier assets have kept the 2-year U.S. Treasury yield below 4%. This indirectly benefits gold as a non-yielding asset. Meanwhile, China has introduced retaliatory tariff measures against US and Canada, escalating trade tensions, while the PBOC's continued gold purchases for 4th straight months have provided support for gold bulls. Additionally, Ukraine accepted the 30-day ceasefire proposal from the US, and the US announced the removal of the extra 25% tariff on Canadian steel and aluminum, temporarily easing market panic. However, the subsequent developments remain quite uncertain. In contrast, the heavy long liquidation and shift of money into US Treasuries following the US Black Monday and stock market crash have provided more certain pressure on prices. So overall, gold is navigating the complex dynamics of rate cut expectations, maintaining a range-bound trading pattern. It seems that at least for now, the Fed is prioritizing anti-inflation over growth. And I believe gold will only have a chance to break out strongly in a rate cut cycle if the policy balance is somehow forced to shift towards the former. However, significant uncertainty remains in the market, and apart from the Fed's rate path, the unpredictable Trump's tariff policies and geopolitical developments are hard to price in. Without clear directional guidance, gold prices are likely to continue trading in a wide range at elevated levels in the short term. While looking ahead to the rest of the week, tonight's US core CPI for February is worth watching. The market consensus is that the month-on-month core inflation will decrease from 0.5% in January to 0.3%, and the year-on-year change is expected to slightly drop from 3.3% to 3.2%. If the year-on-year change is significantly lower than expected, such as 3%, it could fuel market predictions for a May rate cut by the Fed, providing support for gold prices. On the other hand, if the data exceeds 3.3%, gold may struggle to build any bullish momentum, though concerns over stagflation may still provide some support for prices. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!